What's up, guys? So this video is going to be about the market pullback we're experiencing right now and where we could see it heading. So this is kind of similar to what happened back in March when we had the Federal Reserve kind of come out and hint towards interest rates possibly going up. I remember there was a huge contraction. Then Powell came out and said, no, we're not raising rates the rest of this year or whatever. And you saw markets, just literally bounce right back. The what we're sprinkling in now is a little bit of the new vid strain fears, along with the Federal Reserve changing its tone, and so I just want to get into that. So maybe it'll be a good talking point this weekend, when you're having some drinks or whatever, and it's definitely something to consider. When you're Sunday night and you're thinking about, man, am I going to buy this dip? Am I going to double down to it? What do I do? And everyone's opinions are going to differ a little bit, and there's no opinion that's right, but the way I look at it is you should try to get the best ones possible to make your decision. So we'll take it back a little bit to like an economics class. So really the major fear, I wouldn't really worried about the new vid strain, because it is what it is, right? Like, if whatever's going to happen, what that's going to happen, we know what we're going to be able to roll into if there is lockdowns again. So obviously you got to pay attention to that. But the bigger picture here is them saying, inflation is not transitory. So in an economy, when inflation starts running up, there's really two things that you could really do that will keep inflation in check. Thing one, obviously, is to contract the money supply. Thing two is to raise interest rates. And both those things kind of go hand in hand, right? Like, you in order to contract the money supply of something, you have to take money out of the system, and one of the best ways to do that is stop people from borrowing money. So you let the money that's there actually circulate. So the best way to get people to stop borrowing and taking on riskier and riskier debts is to raise rates. And I don't know, my fear is we might experience what we experienced in the 1980s. So, this was towards like the latter end of the Carter era. Inflation was getting out of hand. And really, I want to say it was Paul Volcker was the chairman back then. I think, I could be wrong. But the synopsis of it and what we can learn from it really is, we started spending too much. Things started getting out of control. And in order for us to make sure that America stayed the reserve currency, we jacked up interest rates. I mean, you could ask your grandparents or your parents about it. People that were buying houses, they were paying, like 12% for, their housing and or their mortgage. And over time, interest rates started coming back down, and eventually it got down to like 5-6%, which was like half, which people were like, wow, this is great. And then the dot-com era started, and then the rest of history, you could pick it up from there. But the reason why America did that was, to prove to the rest of the world, like, hey, America is where we want your foreign deposits to come into. So if you got the pesos, you got rupees, you got whatever, you're going to want to buy American-backed bonds, because, we're willing to sacrifice the short term of our economy for the long-term strength of our dollar. And that could happen again. It's literally, less than 40 years ago, we did the exact same thing out of that playbook. It's like, oh, look, there's a play. When inflation hit, this is what we did, and it worked out. But did it cause a lot of pain? Yes, it did. And, the pain was really, if you own a bunch of single family homes or whatever, you're fine. If you've bought your home today, let's just say you close this year and you owe $400,000 on a home and it's fixed at 3.25%. Hey, you're kind of squared away as long as you can make that payment, because there's no adjustable. But anyone, that's in like my position, that owns multifamily, owns commercial loans, which, majority of the people that are employers do, they might be in for some troubling times here in the next couple of years, because let's just say the Federal Reserve, raises its rates. And really, listen, like, the hikes are really going to come down to how bad the economy is getting. If all of a sudden, we're going through the Taco Bell drive-through. Yes, I eat Taco Bell. And, we're paying freaking $5 for a bean and cheese burrito. that same beef and cheese burrito that costs like $1.50, less than a year ago, and by next year we're paying $5 for it. We have a real freaking problem. And that means that the Federal Reserve is going to have to like hike those rates quickly. And they're going to have to try to get ahead of it. And we know how government works. It's always lagged. A matter of fact, when they were saying that inflation was transitory, literally everybody and their mom, like you could have talked to anybody, that owned a business that you knew locally, or even yourself, man. When you were going to the grocery store, you're like, transitory. Okay, but it's at the beginning of the year you were like, okay, I'm paying like $1 more for chicken or for whatever. 6 months in, you're like, oh man, I'm paying a little bit more. By the end of the year, you're like, dude, I was paying more now than I was at the beginning of the year. Nothing has changed. It's just like transitioned into higher and higher costs. Like everybody saw it, but the government relies on data, and the data is always lagged. And at the same time, I don't think it's like a flaw, right? Because you might have a set of data that comes in, and then if you overreact here, you're gonna mess it up down the road. So sometimes you got to go, 3 months, 6 months, 9 months. You might even have to go a year before you're like, okay, there's the chart. We need to correct this, or like, okay, that's a chart. We need to correct this, right? So they're already behind the 8 ball, and whatever decisions they're going to make, it's going to be lagged. So we will actually experience the pain of even more higher elevated inflation before they come in. So once they see that happen, their reaction could be, okay, let's hike it like 1/4%, or 0.5%, and then kind of wait. But if things really start spiraling out of control, like if we see 15, 20, 30% inflation or whatever, which it's possible, they might have to raise interest rates by full percentages, and that is a possibility. And so the effect of that is how this works is the Federal Reserve sets those rates. That's the rate that that people are going to be borrowing at. So then the bank has to make a premium on that. So let's just say hypothetically rates in the next like 2.5 years or 3 years goes to 5%. That means me and you, if we're going to be getting a house, we're going to be paying like 6% interest, 6.5. If the federal rate is 5, and they're going to have to add at least the 1.5% the bank is, or 1.25 to make a profit. So we're paying 6.25%. And for businesses a little bit more risky. Sometimes you pay as high as 1.75, right? So we might be paying, well, let's just chop it up to like 7%. And so what the hell does that mean? That means that's a huge impact. So like think about people that are buying houses today. If you bought a house today for like, whatever you put down, whatever, and you owe 400,000 and you bought it at 3%, 30-year fixed, I mean, your mortgage is probably a couple grand. If you're paying 6%, your mortgage is going to be $4,000. You probably can't afford that, right? And businesses that are taking out these loans, like if you bought a multifamily, property, and now and like let's say you bought in the last 2 years, and in 3 years your note's coming due, you got to refinance, and the bank is like, oh, your interest rate's going to go from 4.5% to 7%. You're not going to be able to afford it. You might start losing assets, right? The bank says, okay, we're not going to refi it. And you're like, oh, you're not going to refi it? Then what do? You got to go to another bank. Another bank's like, hey, man, 7%. That property's not looking good. We can't refinance it. What happens? You got to short sell it. You got to sell it for what you owe on it, and hope that you could get that so you could just walk away without owing anything, or God forbid, you end up, going down. And all of this stuff and all this shit that I'm talking about, I'm not saying for sure it's going to happen, but it's something that the markets are thinking about. Because remember, all the stock market it's a forward-looking market. Like, what are we going to make in the future? And if the market's telling you, hey, in the future, rates are going to go up, a lot of people are like, whoa, hold on, let me take some money off. And instead of me putting money into a tech company that I'm paying today 30 times earnings, let me go throw it into like a Walmart where I know I'll make some cash now, and then once the evaluation goes down, I'll roll back into it, right? So that, I hope, I'm trying to simplify it. I hope that made sense, because basically, to keep it very simple, if rates go up, asset prices go down. It's really that simple. And that's option one. A second option that I see is like, the market, they're going to sit back and they're going to say, well, if, because you're in a rock and a hard spot now, because you need lower rates, because you need people to borrow more, because you want people to continue, you want to give someone money to go start a business so they can hire people so your economy does better. But at the same time, if you raise the rates, and I don't want to start a business, that guy doesn't want to, no one wants to start a business, no one's getting employed, we're in even a worse economy. So you're in a tough spot. So I personally think the other option might be they stay put and they see what happens, and they're like, you know what, we're gonna have to get employment under check first before we could even think about raising rates. So maybe we start following what Japan did, and we have a lost decade. So what does that mean? So what Japan did, we just go negative rates. We go interest rates next to zero. You're buying a home at like 2%. If you're buying commercial loans at like 3%, when inflation will probably stay, at like 4 or 5% inflation rate, and you have a lost decade of that's what they called the Japan time when they went that way. And if you go into negative rates, that means if you have $100,000 in the bank account, they will siphon out like 1/4% or whatever the negative rate is. And that's to encourage people to have capital, to say you can't just put capital at the bank, you need to go put capital to work. And people are going to be chasing yield. So people are going to have to be forced to take more risk, right? And, and why do they call this a lost decade? Why do they call this a lost, whatever? And to me, it's really because if you look at it at the fundamental level, the person that doesn't have assets is never literally going to be able to get ahead. And so if you really want to pin the problem on everything, it's the pure manipulation of markets, and it's hand in hand with the crony capitalism. And we could literally pin it back to 2008, because whoever, I know friends and family that lost their homes, back in '08. They made bad decisions, and you could say, hey, they were under wrong advice from people, and that's all true too. But guess what? They paid the consequence. They ended up losing their home. Unfortunately, they screwed up their credit, but they got back on their feet. They're doing good now. They're doing well now. Like, life rebounded, but they had to go through it. But the rich people in this country did not. And we were sold a lie, and we bailed them out, and we continued to print, and we continued to print. And really, they sold off our future generations' money to try to save them now by putting us more in debt. And now it's coming back to bite them. And I think they could still hold off on it, but it's really that corporate greed, that's killed this country so far. And you could sit there and say, well, look at what the stock market isn't a real indication of what me and you are doing, right? And I'm telling you as an individual, I don't need to tell you, you know this as an individual, it is a lot harder today for you to be able to go out and make an honest living and create an honest life than it was 20 years ago. And it's because everything's expensive. Well, everything has been expensive because we've just continued to bail out and save companies that we probably should not have saved. Like those people that made bad bets, if my friends and their family members and my family members had to walk away from their homes, why should these people be protected? And guess what? We still went through the blunt of it. They would have been like, it would have been as bad as 2000 or 1940s. It would have been the Great Depression. Well, then instead of bailing out the big companies, how about you just bail out the people? We did it during the pandemic. So if somebody was down on their house, instead of going and bailing out, Wells Fargo and AIG and all those guys, and even General Motors because they gave out car loans, why don't you go to the person that owned the home and said, hey, you kind of fucked up. You bought this house, $200,000-300,000 over. Hey, we're going to give you a 2% interest rate. We'll make it a 50-year mortgage. You're a young person. We're going to help you out directly and keep going to work, keep doing whatever. No, because that's not how it worked. It was crony capitalism. It only worked for people that had the handshake and the back doors and smoking cigars with the people that needed to be it. And in my opinion, that's still, those decisions made there are still impacting what we're doing today with the quantitative easing and the money printing and all that, because it doesn't make sense. And you could only keep this game going on for so long. I mean, even if you save it this decade, even if you save it the next decade, eventually there comes a time where numbers need 1 + 1 = 2. Like you can't tell me it's going to equal 3. And, that time is going to come. And people talking about why are cryptocurrencies so high and stuff, it's because, literally Bitcoin was made with the article starting out with saying the government has printed money to bail out this company. That's not what money was supposed to do. And so, I heard these articles about, Munger saying cryptocurrency were never been invented. Look, there's going to be a lot of bad cryptocurrencies, but there is a lot of good ones too. So anyways, I hope you guys found this useful. Just watch out for the rates. If you like the video, please share it. Help me grow the page. And if you got comments or opinions, drop it below. I'd love to hear it.